everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending October 1st, 2021. I'm Preston Brent. Thanks for tuning in. Can you hear that clock ticking, everybody? Tick tock, tick tock. Well, that's the debt ceiling, and I'm making the assumption that cooler heads are going to prevail, but not without a lot of drama. But before we get into that, let's just kind of take a look at where we've been this past week and how things are shaping up for an interesting follow-on week this coming week. If we take a look at the weekly sound bites, we'll look at index performance first. You can see in the U.S., everything was in the red. Now, even given the strong move that we had on Friday to the upside, we saw that everybody was still solidly in the red. We finished the month of September in one of the worst monthly declines that we've had since February of this year. It was down about 4.65 in the S&P. We finished the quarter barely in the green, 58 basis points. So just a really interesting finish to the month of September. And as I've told all our members, we've been expecting a 5 to a 10% pullback for about 60 days now. Now, do I think this pullback is done? No, but I'll show you the charts here in just a minute. If you look at the best sector performance for the week, energy just blew away everything on a strong demand, not enough supply, 5.78%. Worst sector, healthcare, by 3.52%. You can see leading the way annually, energy, almost 50% for the year, coming in about 47%. Utilities in the green, but just barely at 4.22. You can see the forward PE ratio still elevated, 22.04 in the upper right-hand corner. Dividend yield in the S&P closed out the week around 1.34. 10-year Treasury closed out the week 1.46. So it's higher than the dividend yield of the S&P by 12 basis points. The earnings yield in the S&P is at still around 4.71%. So the yield in the S&P over the 10-year Treasury for big money, still 3.25%. So that's a pretty good hefty number. It continues to support money coming into the equity markets, okay? So we've got that support underlying the overall markets. Now, volatility for the week closed it out 21.15. It was up about 16% for the week. The prior week, the VIX closed at 17.75. So all in all, it was a fairly choppy week for performance. And of course, if we look at the economic data for the week, we did see the Commerce Department's core personal consumption expenditures, the PCE price index. That's what the Feds use. And I don't know why they do it, but they take out food and energy, which to me are a big component of inflationary pressures that consumers feel. But the Feds like using this primarily because the number is lower. But the Fed's preferred inflation gauge, it was right now it's about 3.6% over 12 months ending this past August, right? Which is kind of at consensus. However, we're starting to see inflation concerns growing among consumers, right? We did see growth in durable goods for the week, and we did see a big uptick in new home sales prices. So we're seeing some of that come out. Now, if we look at the Treasuries, the yield on the benchmark 10-year, it spiked to a 3-month high earlier in the week, and then it kind of closed out the week, falling back to where we started the week. Really negative headlines about energy prices. That big Chinese property developer, one of the largest in China, Evergrande, and a gridlock in Washington kind of has weighed on investor sentiment here. But we did get yields a little bit lower towards the end of the week, kind of where we started, as I said, okay? And of course, if we come over and we look at Europe, see what's going on over there on a year-over-year basis, CPI jumped 3.4%. in August, up from 3% a month earlier. And that's the highest level it's been in Europe since 2008. So they're having inflation pressures there too. In fact, the ECB president, Christine Queen Bee Lagarde, is what we like to call her, she acknowledged in testimony in front of the European Parliament that inflation across the Eurozone could exceed their forecast, which is exceeding everybody's forecast. Right? It's not as transitory as the central bank leaders have suggested. And by the way, they've already raised their forecast twice this year. Meanwhile, over in the UK, Bank of England Governor Bailey, he said that the UK GDP probably won't recover to pre-pandemic levels until early next year. So everybody's pushing out their overly rosy forecast. All right. Now, if we go over to Europe and look at the European performance, you'll see it was pretty much in the red all across Europe as well. The Euro stocks, the 50 largest companies there in Europe, across European zone, down almost 3%. FTSE, CAC 40, DAX, all of those, DAX being the biggest widely followed because it's Germany, all in the red for the week. You can see year to date, everybody's still solidly in the green. Okay. The Nikkei came down a good bit to 4.89% over in Japan, and China in the red. Hang Seng finished in the green, and you can see all year-to-date performance right now. Japan, they've elected, or who's probably favored to be elected prime minister is Kishida, and he's viewed as a consensus builder. He's also very dovish on fiscal policy, which also kind of comes in alignment with their Bank of Japan Governor Kuruda. So that's helping support the Japanese markets year to date. That's why they're in the green. China, meanwhile, they got their own problems, with their China Evergrande group, and the People's Bank of China has come out and said, be prepared for defaults. But what People's Bank of China, PBOC, and to say it better, probably China itself, the government, the CCP, they're going to support Evergrande, and they're not going to bail Evergrande out. What they're doing is they've instructed a lot of their state-owned enterprises and local enterprises, because Evergrande has got 800 projects spread across 200 mainland China cities, right? That's huge. So basically, the CCP came out and has instructed a lot of government-owned entities to come in and buy debt or buy the projects off of Evergrande. So Evergrande's going to be forced to sell these projects to help pay off their debt load until they get it all sorted out. And this just past week, they sold a 20% stake in one of their projects to a state-owned enterprise for about 1.5 billion US dollars. So that kind of helped improve sentiment a little bit in China as well. All right. And separately from that, the PBOC kind of pledged to ensure a healthy property market and to protect home buyers. Because the last thing China needs is they got all their screaming Chinese over there that own some percentage of Evergrande, whether they bought a property and they're waiting for it to be built, or they invested in a large building, a unit in a building, they're waiting for it to be built. And the last thing the CCP needs is a million Chinamen running around all pissed off at the government. So they're gonna edge them out of it. So I think that's gonna kind of come off the front line news of China, right? I don't see that as being anything big. It was kind of a frontline number, but that's kind of where we're sitting right now. But it was enough to upset the market just a little bit, right? So that's kind of how we're sitting right now in the markets. All right, so what I want to do is I want to basically come over and let me just switch the screens here for a minute. So let me take you over to the E-mini S&P 500 futures. Let me get it over here to that screen. And what you're going to see is, in my estimation, another potential bull trap setting up. All right, that means when the markets go higher, everybody starts to log in, the buy the dip crowd jumps in, and then we roll right back over again. Keep in mind, September is traditionally one of the worst months of the year in trading. October, it's kind of bifurcated. The first 2 weeks, 2.5 weeks of October tend to continue the doldrums from September. And then as we get past the middle of October into the end of October, the markets tend to pick up, and then through November and December, we have a strong time of the year, okay? So if you look at this chart here, as I've been saying, when we blew through the 50 EMA here on September the 19th, remember, this is the first time we had 2 consecutive closes below the 50 EMA in over 250 days or so, right? For the entire year of 2021, every time we crossed the 50 EMA, we had a green bar behind it, and the buy the dip crowd came in. And this was the month and the time, and probably even a higher probability time, that we just blew through it, right? Now, our intraday low, and let me just change my my calculator here and just put it on a ruler. The intraday low for the markets came in right around 6.32% thus far. Now, I had changed our forecast, my forecast, from a little more than a 10 to 15% correction to a 5 to 10% because there's so much money floating around in the market right now. It's just a ton of money with nowhere to go, right? Yields are still on a relative basis very low historically. So 6%, and keep in mind, since the March 23rd lows in 2020 with COVID, we've had about 5 or 6 pullbacks. The average pullback has only been about 7.2%. We did have an official correction last September in the markets in the S&P, and I think we could get close to that again. If I take us down to the 200 EMA, which is the yellow line, that takes us down to right around 9 to 10% pullback, right? And that would be very in line with what happened last September. Then we had a retest close of those lows in the first couple of weeks of October. And then we just rolled, and then we just continued to boom in early November. We haven't looked back since, right? So that's kind of what I'm seeing here. So if we look at this and I mark up the chart, you can see the Elliott wave count that I have on the chart here is still a 1 leg, 2, and then a 3 down here. It'll probably, the chart's estimating a 4 up here, and then a 5 somewhere down here, right? And it'll take us down to the 200 EMA. You can see it's got a little small 3 here, which suggests the 3 leg can go actually lower, just because of all the momentum in this down move right here. This was a bull trap, right? As you can see, we took out that low right there intraday. So there's still a lot of buy the dip crowd in there, but there's no divergences here to speak of. That would suggest that any rise higher, keep in mind the 50 EMA, if I extend that line, it's got a downward trajectory on it. I'm going to watch the 50 EMA to see how price action revolves around it. If we climb back above the 50 EMA, we do probably a normal retest, and then we move up, take out the first pivot high above the 50 EMA on that breakout. Then I think we're going to come up and challenge this level right here. That'll be the next big hard test. We got actually a range. It kind of goes from here to here, right? That is the range right in there. We take that out, then we're going to make new highs. Now, I think we're going to go lower, and then I think it's going to reverse, and we'll finish the year choppy to up, all right? That's kind of what I'm looking at right now. That's the way we're playing it in our markets, the way we're doing it here in our user group. We're doing very well this year. We got some trades that are just, bringing us money. But also keep in mind with this looming government shutdown and debt ceiling standoff, I think we're going to see the market start to factor in more of an argument between the Republicans and the Democrats. Right now, the Democrats are kind of in an array here. They're kind of mixed up, fighting with each other. And as I always say, just let them fight and do damage to each other. And then when they surface, let's see what we need to do. But that's what's going to happen. So there is a lot of risk still floating around in this market. And the other thing that we've seen is a return to value over growth, right? If I just come in here, let me just come down to ratio charts here. And I'm just going to look at a couple of things, growth versus value right here, IWF over IWD, right? You can see here that with growth in the numerator, really, its growth kind of topped out in mid-September. And as we started pulling back, value's been outperforming growth, right? Now, none of these have lasted very long. Every pullback that we had, like right here in July, value over growth, it only lasted a very short period of time, right? Really no more than about 3 weeks. Right here, if that holds true again, we'll see growth start to pick up. Keep in mind that value tends to move higher when we have rising inflationary pressures, rising interest rates. Technology tends to underperform others, okay? And I do believe that part of our inflationary data is sticky, i.e. labor and wage growth, but some of it is transitory. But you got to define the duration of transitory. Traditionally, transitory in my mind was about 90 days and then it goes away. But now Boom Boom Powell is coming out saying, well, it's transitory, but it's probably not going to go away till next year, the summer of next year. A lot of these supply chain bottlenecks, if you looked at the data coming out of the ports on the West Coast, it's taken a lot longer to offload the ships. They're lined up on the ports there. The transit time is another 40 or 50 days longer than it normally is from China to the West Coast. You've got problems offloading because you can't find truck drivers and others to transport it inland. And it's just going to back up, right? So just understand that. So value is outperforming growth, and it started that process about the middle of September, okay? And that tends to hurt technology a little bit, right? If we look at technology as it relates to the S&P, you can see here really starting about that same time, it's gone down. And when that goes down, that means the S&P is outperforming the tech sector because the tech sector broke the 50 EMA, this ratio chart of technology to the S&P. Okay, so these are just some of the ones that I'm seeing here that are just sticking out a lot. All right. Now, if we come over and look at the FANG index, which is a customized index I have of Microsoft, Facebook, Apple, Netflix, Google, and Amazon, you can see here it has been coming down a pretty good little bit, right? We had that little bull trap. You can see where we held the 50 EMA and then we broke it. Now, 50 EMA, which was support right here, is now resistance right here. So for me to kind of lean a little bit more into tech, if we do have that transition from value back to growth and leaning more in tech, then I want to see us regain that 50 EMA, okay, in this index. So these are just some of the things I'm watching. And of course, Nasdaq, which is comprised of mostly tech, of which the FANG index is probably about 40-45% of Nasdaq futures. You can see here, we're well off of the 50 EMA. We blew through this little resistance zone right here. And it's kind of in a support zone right here, or resistance until it finally broke through. But I do believe we're going to go lower over the next month. All right, so we've got to watch this very closely, guys. Of course, if we look at volatility, if we look at the VIX itself, you can see it came down hard on Friday. But we're still in this red zone, towards the lower end of the red zone, which is, I still characterize as down fast markets, okay? And then we get into a choppy market right here. We haven't been in the green since the pandemic, since prior to the pandemic. The green would be seeing a couple of closes in the VIX below 14, right? So we're here. We took out these prior highs right here with the VIX. So this just tells me that the markets are very sensitive now to downward moves, okay? We got to follow it very closely. And if we look at our front month vol skew, right, that's the VIX compared to the volatility futures. Notice we were in the red on Friday until we had that big move. And then we moved back into the green, but we're in the upper boundary of the green. So we're almost flat into the vol futures and as far as contango versus backwardation. So we're just barely in a contango term structure. And if we look at the back month vol skew right here, it's a little bit more solid in the green. All right, it's the daily chart. You can see it came down. We're near the lower level of where it's been in the green. So keep in mind, you always want to follow the term structure of volatility in the options market because it just tells you the degree of fear that's out there, okay? And it says near term, we got a lot more fear than further out in time, which would logically and rationally make sense if you look at the stats of November and December, going back a couple of decades of market performance. And this is in alignment with that, okay, so far. And of course, if we look at the bond market, the bonds had a strong move higher right here. That's off of this low right here. We hit a pivot point here, and you can see we bounced right off of it. Okay, you can see over here it's resistance, and then once we broke out, we had that typical transition from resistance to support, broke out, and then we came back, found support, and it took off. Now, up in this level here, as I'm telling our members, we want to be short the bond market. We want to be long interest rates. Okay, now this little respite here is just, in my mind, a bull trap, and the bonds are going to roll over again. If we look at the 10-year interest rates, it's going to be just the inverse of that. We found the 50 EMA as resistance, right? The 200 EMA roughly as support. Now that we blew through it, this is going to be a bear trap. I think it's going to eventually move higher. Okay, now we closed right around 146 for the week on the 10-year, and I think we're going to be back up near the highs by year end. The highs for the 10-year were made in March of this year at 176. Okay, that's kind of how we finish that out in interest rates. So I think interest rates are going to slowly grind higher. And of course, in our user group, we're trading rates, and which it's the same time, it's the same thing as trading bonds, right? Now, the US dollar is an interesting case, okay? No one forecasted the dollar to move up like this, and it has. And I think we're going to start to see, in fact, I didn't even mark it on my chart, but you can see here that we've now made new 2021 highs in the dollar index. Up here, I would be a seller of the dollar instead of a buyer, okay? When we've got tails of inflation starting to come back in, we're starting to see growth in the economy, the reflation trade coming back in, and the dollar is going to start to enter into a longer term bear cycle, then we want to be long the euro, not long the dollar, all right? And there'll be some trades setting up that for our weekly market watch for our members tomorrow evening. We'll kind of go through some of those. If you're not in our user group, I highly encourage you to come in, because we trade all asset classes, and you need to understand the macro view before you start diving into the micro trades and the various sectors, asset classes, and so forth. So that's kind of what I'm seeing there in the currency side. I'll go in a little bit more detail with our members tomorrow evening. And of course, if we look over at metals, typically when you're in a bear cycle in the dollar, the gold is going to start to turn more into a bullish cycle. Now, I like gold and silver longer term, but I think silver right now is a better buy. It's underperformed more. You can see we're barely hanging onto this area right here. We broached it, we came immediately back into it. And if I step it out, you'll see just how important that level is, right? Look at that level right there. If we break that level, I've got a bigger, longer term natural support area here around 21.25. And if it breaks that, we're going to go down all the way down to the high teens. I don't think that's going to happen, right? You can see on here, on this chart, where we're showing some divergences here. So there'll be a trade in this. Members, we'll talk about it tomorrow evening. But that's kind of what I see in silver and gold. Copper, well, what can I say about copper? It's in sideways patterns, but longer term, we're bullish copper. Members, you know why we're bullish copper, and we'll stick with longer term bullish copper, all right? And just the way we're trading it is a nice play. One thing I forgot to talk about is Bitcoin. Very strong couple of days. You can see Bitcoin moving up off these here. I do believe Bitcoin's going to move up to the high 50s, low 60s. We're playing this using some strategies. We've already adjusted our strategy. So we're long Bitcoin using an interesting strategy, and we have zero downside risk, right? So it's great to play Bitcoin long, yet have zero downside risk if you're wrong. So we got an interesting trade running on in the options market on that one. And we'll follow that one. If it runs back up over 60, 65, we'll probably make 7 to 10 times our investment on that trade. So that'll be a real interesting play there. And we're just taking advantage of an option strategy that we use to play asset classes that we want to be longer term bullish, okay? So that's kind of what I'm looking at here in metals. And then of course, if we come into energy and we look at oil, you'll see on the oil chart here, we're coming up and we're going to challenge the 2021 highs. I do believe we're probably going to come up and see the 80, low 80s area. You can see my Elliott wave forecast is forecasting high 80s. at some point in time, okay? I've said right over here, I said fade this move, and away we came down. Once we broke out of here, we established a new trend to the upside, and condors or call condors favoring the upside, and options on the oil futures market always makes sense, or owning some of the oil majors, selling short calls against it, collecting dividends also is a good play, because oil is cyclical based. It goes in cycles, and it can change on a report coming out of OPEC on a dime. So the better way to play oil is not with just long or short futures, but in the options market on oil futures or in XLE or some of the majors. Right? You don't have that kind of volatility. Now, there are other things going on in the ag, meats, and soft market, but I'll limit my discussion in our weekly roundup to just some of these majors here, some of these major asset classes that we talked about. All right, everybody, have a great weekend. Members, I'll see you tomorrow evening, 8 p.m. for our weekly market watch. If you're not a member, highly encourage you to come in and join us. We're having a lot of fun, and I promise you, the next 6 months are going to be very exciting, and there's going to be a lot of surprises in the market. We'll be ready for them, and we'll be ready to make some money in them, which is what the name of the game is. Have a great weekend, everybody. Enjoy football for you football fans out there. Take care. Ciao.